Well, Joseph Mason is a visiting scholar at the FDIC and also a professor of banking at Louisiana State University, joining us from Dallas this morning. Thanks so much, Joe, for being with us.
Thanks for having me.
And, as I recall, having reported on business news for quite a few number of years, credit rating agencies are always to blame whenever crises happen. And yet nothing ever really happens to fundamentally change them. Is anything going to change this time around?
No, not really. I hate to make it that short,
right.
But for the most part, in fact, it's regrettable. And in fact, credit rating agencies themselves seem to want some changes right now that, in fact, neither Congress nor the SEC will deliver.
Okay, so then what is at the crux of this, Professor?
Well, the crux of the problem is with the crisis is obviously that rating agency models failed. That we all know, that the rating agencies also know, and they also understand the concept of ratings inflation going into the crisis with respect to structured finance particularly. That we've known since the mid-1990s, quite honestly. None of that is new. What ratings agencies would like right now, in fact, to rebuild their reputations is a movement from regulators, from Congress, to actually give them a hurdle to specify what ratings mean in terms of probability of default or expected loss, and be honest with the investor and be held to that bar. Of course, that's not what Congress is delivering. Congress is messing around with liability concepts, which would be disruptive and not really ineffective either. If you've ever tried to sue, say, a big accounting firm, you can anticipate how difficult it will be to sue a ratings agency on an individual action. So that doesn't really change anything in the vast landscape.
Yeah, and you're right about that, that really a lot of this has to do with, okay, well, if the credit rating agencies are wrong, let's just go sue them, and that's going to reform things. But what you're saying is essentially we need more transparency coming out of these agencies. And as I understand, they're willing to do that. So I'm still not quite getting then why is it that we're not getting that?
There still just seems to be a disconnect on the Hill, both in Senate and House, on the ratings agency issue, an unwillingness to really come all the way to understanding the nature of the economic market for ratings. It's a two-sided market. You're selling to both the firms and the investors, and there are natural conflicts of that, just like in telecoms and other industries. But more importantly, I think the big problem is these are just credit ratings that have been used for regulation. They only measure the probability of default, not liquidity risk, not market risk, nothing else under the sun. Now, rating agency reports include those dimensions in their reports, but not in those letter credit ratings. So those ratings obviously miss these other risks that help contribute to the crisis.
And are they going to continue? Because, for instance, I was reading this morning a Bloomberg story about the fact that now we're getting rating agencies continuing to upgrade. In fact, they're upgrading more companies than they are downgrading since the second quarter of 2007. It's back to business with them.
Well, it is, but remember, again, those upgrades are only with respect to credit, not with respect to liquidity. Clearly, nothing selling in the marketplace today. So as long as we just maintain this unidimensional focus on credit with respect to regulation and other things, we're going to get the same outcome. We need to recognize in this world, especially in the world of financial engineering, different types of risks are fungible. You can trade credit risk for market risk or liquidity risk or FX risk. And so if all we're going to measure is credit risk, we're obviously going to lose a big part of the risk landscape.
Yeah, we're going to miss a major part of things. Okay, Professor, good to talk with you. Thanks so much.